In this video, I'll explain all the basics that you need to know to understand a very important investing tool called mutual funds, and we're starting right now. Hey, what's up everybody, and welcome to another video from the Keystone Financial Academy. My name is Elliot, and before we get going, if you are new to this channel, I invite you to join our community by subscribing and turning on notifications so you don't miss any of the upcoming financial and investing topics. Okay, let's talk about mutual funds. As I mentioned in the intro, this is a very important investing tool. Whether you have a little bit of experience with them or you're completely new to mutual funds, you need to understand their fundamentals so you can use these funds to invest and grow your wealth. So what exactly is a mutual fund? It's nothing more than a pool of money for many investors used to purchase securities such as stocks. So this is kind of the opposite of picking out stocks one by one on your own. You're giving money to the mutual fund and it will buy the stocks for you. So why would you do this? Well, for starters, a mutual fund may be managed by someone who is, in theory anyway, better than you are at picking stocks. The second reason may be that you just don't want to or don't have the time to do your own research and picking the stocks, but you still want to invest in some way. Mutual funds make this easy. You just pick out some top-rated or top-performing funds, buy some shares, and let the pros do the hard work for you. Mutual funds also allow you to diversify and hold a wide variety of stocks, or hold certain types of stocks that best match your goals or personal philosophy. If you want to invest in clean energy, for example, there are mutual funds just for that, and you don't have to research and buy dozens and dozens of individual stocks. There are also special types of mutual funds called index funds that hold the same stocks as several of the stock market indices, and I will dedicate an entire video just to them. Now, mutual funds are a pretty simple idea, and in theory, anyone can set up and run one. As an example, let's say you know a guy named Dave, and Dave is a big techie. He knows every piece of computer gear, audio gear, and gadgets, etc., and he even runs a blog that reviews all sorts of high tech. Let's say he gets this idea that because he knows these tech companies and the products so well, he's going to start up a mutual fund that invests just in these companies. He convinces 20 of his friends to give him $1,000 each, and then takes that $20,000 and buys a few shares of stock each from the, let's say, 30 or so companies that he knows really well. And he calls it Dave's Awesome Tech Fund. All his friends in turn buy up shares of Dave's Awesome Tech Fund equal to how much they put in minus the service fee, because Dave decides that he wants 2% of the fund total, or $400, for his efforts in setting up the fund, managing it, and running it. And so it went. Dave would, of course, keep an eye on the stocks in his tech fund and occasionally replace some stocks that weren't performing well with some new ones that were performing better. And his fund did really well because he was really good at picking the companies, and the shares rose in value. Word of the fund spreads, and next year another 10 friends decide to join in with $1,000 apiece. The fund has now grown to $30,000 of initial investment, and it went up in capital appreciation by, let's say, $10,000, so it's now worth a total of $40,000. The fund keeps growing year after year as more people join, and of course Dave is happy too because his management fee goes up as well. This really simplified example is essentially how a mutual fund is created and operated. Except instead of Techie Dave, we have a financial corporation which hires a professional manager and a team of analysts to run the fund. And instead of 30 of his friends, we have tens if not hundreds of thousands of investors putting in millions of dollars in total. So hopefully with that little story about Dave and his fund, you have a pretty solid idea of what mutual funds are. Let's now go over some really important additional information about mutual funds, starting with the way they can be categorized. By far the most important distinction you can make is whether a mutual fund is actively managed or passively managed. An actively managed fund is exactly what Dave's Awesome Tech Fund was. There's a manager or a team of managers and analysts, and they pick top performing stocks to add to the fund, and then they remove the poorly performing ones. These funds are typically pretty aggressive, and their goal is to beat the market. In other words, return more than the market average. The upside here, of course, is that in the right hands of a talented manager, the fund can give you some very impressive returns. The downside, of course, is that the manager could be wrong and he could pick too many losing stocks and not enough winning stocks. In either case, there will be a percentage of management fee charged, so these managed stocks can get quite expensive. A passively managed fund has no management and no management fees. So how do stocks get picked and managed then? Well, they don't get picked or managed at all. Passive funds by definition are index funds and automatically invest in the same stocks and in the same proportion as the index that they're tied to. This index is usually the S&P 500, but it can also be the Dow 30, NASDAQ Composite, or any of the other indexes available. So there's virtually no management needed, and index funds are super cheap and pass these savings right on to the investor. As I mentioned earlier, index funds are a topic that are important enough to have their own video, and I'll link to it in the description below. For the rest of this video, we'll just talk about actively managed mutual funds. The next really important topic to talk about with mutual funds are the costs and expenses that I mentioned earlier. There are two types of fees that an actively managed mutual fund has. First is the transactional fee or load, and this fee is imposed when you buy or sell shares of the fund. Second, you have the annual ongoing management fee, also known as the expense ratio. So the first item, the buy and sell transaction fee or load, is just another name for a commission and is paid out by the fund to brokers and other marketers. When you hear a fund referred to as a no-load fund, that means there are no fees to buy shares of the fund, and that is actually a huge plus. A lot of funds do have loads though, and you should be aware of two distinct types. The first type is the front-end load. This is the more commonly found load, and it charges you up front to purchase shares of the fund, usually a one-time fee. It's expressed as a percentage, so if you have a 5% load and you invested $10,000, that's actually $9,500 invested and a $500 fee. The second type is the back-end load, and as you would expect, this is the fee to sell shares of the fund. This can get a bit more complicated though. In order to incentivize the investor to buy and hold the shares of the fund, they may get progressively less, from say 6% if you sell the shares in the first year, all the way down to 0% if you sell the shares in the 6th year of holding them. So a typical fund may have a combination of front-end and back-end loads, where the front-end you pay initially when you buy, and the back-end loads get phased out over time. The second fee is of course the money you have to pay the management team for what is hopefully effective and skilled management of the mutual fund. This management expense ratio is taken out of the market returns of the fund, so investors end up paying for it indirectly by earning less on their investment. Also in there is a variety of marketing and administrative fees that the fund needs to operate and advertise and market itself with. In total, all these expenses and fees can be upwards to 2% of the fund total annually, which is an astronomical amount of money if you think about it when you have a $10 billion fund. Passive index funds can of course have much lower management fees, as there is much less management necessary. Now if you're saying to yourself, that's a lot of fees I'm being charged, can I get a break on the cost here? Well, yes, you can, especially if you're investing a lot of money into the mutual fund. It turns out the world of mutual funds is not much different from Costco, where you save a lot when you buy in bulk. There's something called break points or tiered price points, where you can save or get a discount on some of the load fees charged. Where exactly these points are depends on the fund, but they're typically in steps of $5,000 of invested cash or $10,000. You also have something called rights of accumulation, where you can purchase and accumulate these shares of the fund over time, not all at once. There's even something called a letter of intent, where you state in writing that you intend to purchase a certain amount of shares after a certain amount of time, and they will give you a discount on the fees up front, assuming of course that you live up to your side of the agreement and you end up buying the shares that you promised you're going to buy. If you don't purchase what you said you're going to purchase, the fees will of course come back. So yeah, maybe you won't get much out of these savings if you're a very small investor, but you certainly will if you're investing with some deep pockets. Next question is, what types of mutual funds are out there? Here the sky is really the limit, because there are just as many mutual funds as there are investing opportunities. There are numerous mutual funds that focus on value, growth, or income stocks, or invest by categories such as a certain sector or industry, or by philosophy such as the previously mentioned green energy. On the flip side, there's even something called vice funds, which invest in alcohol, tobacco, and casino stocks. So really whatever approach or area of the economy you wish to be a part of, there is a mutual fund that can take you there. There are also mutual funds that invest in bonds, and they have their own subcategories such as municipal bond funds or government bond funds, corporate bond funds, and many others. There are still more mutual funds that specialize in international stocks, precious metals, commodities, mortgage-backed securities, and many other categories we could spend hours talking about. So how big is the mutual fund world, and how do you get started investing in it? Well, let's answer the first part first. There is over 40 trillion, yes, that's trillion with a T, invested in mutual funds around the world, with 110,000 different mutual funds available worldwide. Here in the US, there's about $16 trillion invested in various mutual funds, with over 9,500 available. Some of the biggest mutual fund and index fund companies out there are ones that you probably heard of, such as Vanguard, Fidelity, T. Rowe Price, Dreyfus, BlackRock, and many others. If you want to start investing in mutual funds, you need to do a little bit of research and focus on two key items. First off, check the historical returns on a mutual fund for 1 year, 3 year, 5 years, and 10 years. Then check on the expenses, such as the loads, front end, back end, and the management expense ratio. You will of course want to pick out the best performing fund with the lowest expense ratios and fees. Now, you're not likely to find that perfect fund with the low fees and great performance, but try to find one with a compromise of the two. And while you're looking, keep in mind the very important point in the finance investing world, that higher fees do not necessarily correspond to better returns on your investment. Let me actually repeat that in big bold letters. Higher fees do not necessarily correspond to better returns. When you pick out a fund that interests you, but before you commit your money, make sure you read something called a prospectus. This document is mandated by law and spells out every detail of how the fund operates, its investment approach, and all its fees. Okay, so to close out this video, let's take a quick look at a typical managed mutual fund. The one I picked to show you is from Fidelity, and it's called Select Consumer Staples Portfolio, with the ticker symbol of FDFAX. It's a typical consumer defensive fund and a good representative to take a look at. Here's what it looks like through the TD Ameritrade interface. As you can see right here, each share of the fund costs $87, and it's a no-load fund, so it won't cost you anything to buy in, which is always a positive. It has a fairly typical expense ratio of 0.75, which means it will cost you $7.50 in fees for every $1,000 you invest, or $75 for a $10,000 investment. Taking a look at the fund's portfolio, you can see it's made up of 44 stocks as determined by the fund's manager and analysts, with the top 10 holdings are listed right here. You can of course see all the holdings if you wish, and they're about what you'd expect in this type of fund, with Procter & Gamble, Coca-Cola, Walmart, Costco, and other such consumer staple companies in there. Finally, let's take a look at the fund's performance, which I took from Fidelity's own site since I felt their graphics were a bit better. The performance is not terribly impressive when compared to the S&P 500, with the fund underperforming it when viewed through the 1 year, 3 year, 5 year, and 10 year benchmarks. This actually isn't very surprising since these are defensive stocks and they tend to really shine in a down economy, and we've had a very booming economy in the last 10 years. And the fund that invested in non-defensive stocks would have certainly done better. It'll be interesting to see how the fund performs as 2020 closes out, however, since the economy more or less fell off a cliff due to the COVID-19 pandemic, and I suspect these returns will be significantly different. Okay, so that was a quick primer on the fundamentals of mutual funds. As always, be sure to subscribe and hit that like button, and also tell me in the comments below what topics you would like to see me discuss in more detail. Thanks for watching, and I'll see you all soon.